You have $1,000. You opened a brokerage account. You went through all the screens, verified your identity, linked your bank, waited 2 business days for the money to clear, and now it's sitting there, ready. And then you see the search bar. And something in your brain, something that feels like confidence, but is actually one of the most expensive feelings in personal finance, makes you start typing a company name. That moment, that exact moment right there, that is where most first-time investors make the mistake that will quietly cost them thousands of dollars over the next 20 years. And the reason it costs so much is because it doesn't feel like a mistake at all. Here is what makes this particular mistake so hard to catch. It's not that you're being reckless. It's not that you're being lazy. It's actually the opposite. You are trying to be intentional. You're trying to make a real decision, not just throw money into some faceless fund and hope for the best. You want to feel like an investor, not a passive participant. That instinct is completely understandable, and it is, dollar for dollar, one of the most reliably expensive things a first-time investor can do. Today, I'm going to show you why, with the actual math, and then give you the specific step-by-step alternative that the data has supported for 25 years running. I'm Cole, and what this video is going to do differently is name the specific feeling that drives the wrong first investment decision and show you the dollar amount that feeling will cost you if you follow it. Let me give the villain in this story its actual name. It's called the Intentionality Trap, and it works like this. When you have $1,000 ready to invest, every piece of content you've ever consumed about investing, every YouTube video, every Reddit thread, every finance TikTok, has been quietly teaching you one thing, that picking something specific is what real investing looks like. Stock picking has a story, it has characters, it has drama. The person who spotted Tesla early, the guy who loaded up on Nvidia before the AI run. These are the stories that go viral because they're compelling. Nobody makes a viral video about the person who bought a total market index fund in 2005 and just left it alone. But here's the thing about those stock picking stories. For every one you hear, there are hundreds you don't. The people who picked the wrong company, or the right company at the wrong time, or the right company but sold it in a panic during the first 20% drop. The intentionality trap is what happens when the stories you hear about investing are not a representative sample of what actually happens to investors. You end up with a mental picture of what good investing looks like that has almost no connection to what the data actually shows. And the data, as we're about to get into, is genuinely not close. Let me ask you something. What do you call a person who spends their entire career analyzing companies, has a Bloomberg terminal, a team of analysts, access to private earnings calls, and manages billions of dollars for a living? Statistically, you call them someone who cannot beat a basic index fund. That is not a hot take. That is 25 years of documented evidence from the SPIVA scorecard, S&P Dow Jones Indices annual report that tracks professional fund managers against their benchmarks. The full year-end 2025 results were just released, and they found that 79% of all actively managed large-cap U.S. equity funds underperformed the S&P 500 last year. 79%. But wait, zoom out to a 20-year window, which is the window that actually matters for your $1,000. Over the 20-year period ending 2024, 94% of all actively managed domestic funds underperformed the total market. 94%. Let me put that in human terms. If you gave your money to the average professional fund manager and waited 20 years, you had a 6% chance of coming out ahead of just buying the whole market and doing nothing. 6%. The roulette wheel at a casino gives you better odds than that. So, here's the question I want you to hold in your head. If 94% of full-time professionals with every resource imaginable cannot beat the market over 20 years, what are the odds that you, with your first $1,000, can pick the right individual stock on your first attempt? That's not me being harsh. That's just the math being honest. Okay, the mistake comes in 3 flavors. I want you to recognize all of them, because the third one catches people who think they've already learned from the first two. Flavor 1, the individual stock. You open the account, you type a company name. It's a great company, you believe in it. You might even be right about it. But here is the thing nobody tells you. Buying shares in a great company and making money from those shares are not the same thing. By the time you think a company is great, millions of other people already thought that first, and they already bid the price up. You're often paying a great company premium on top of what the stock is actually worth. This is particularly sharp right now. The top 10 companies in the S&P 500 currently account for roughly 40% of the index's weight, double what it was in 2015. Those 10 companies represent 40% of the index's weight, but only 32% of actual earnings. You're essentially paying a significant AI hype premium on top of the business fundamentals. The hope is already baked into the price, not just the reality. Flavor 2, the actively managed fund. This is the sneaky version, and it's where the fee conversation becomes everything. You decide not to pick your own stocks. Smart. Instead, you give your money to a professional that picks stocks for you. Feels like you solved the problem. But those funds charge you for the privilege. The average actively managed equity fund charges 0.64% of your money per year, according to the Investment Company Institute. The average total market index fund charges 0.05%. It's a difference of like 60 cents per $100, you're thinking. Who cares? We'll do the full math in a minute. For now, I'll just say, over 20 years, on $100 a month, the difference between those two numbers is about $5,000 that quietly leaves your account. Over 30 years, it's closer to $18,000. Those aren't fees you see. They come straight out of your returns before you ever notice them. Flavor 3, the trending asset. This one doesn't need much explanation. You've seen it. Crypto tokens, meme stocks, whatever sector the internet was excited about last week. The defining feature of this flavor is urgency. This is moving now. You have to decide now. And that urgency is not a market signal. It is a product. It is manufactured to make you act before your brain has time to do the math. Every time you feel that rush to invest in something because it's moving, that feeling is the product, not the investment.
There is a fourth cost that doesn't show up in any expense ratio, and it might actually be the biggest one. Dalbar is an independent research firm that has been tracking investor behavior since 1985. Every year, they publish a report called The Quantitative Analysis of Investor Behavior, basically a study of the gap between what the market returned and what the average investor actually received. Over the 20-year period ending December 2024, the S&P 500 returned 10.35% per year on average. The average U.S. equity investor returned 9.24% per year. That's a 1.11% annual gap that has nothing to do with fees, nothing to do with which stocks they picked. It's purely behavioral. Panic selling when the market drops, buying back in after it recovers, chasing last year's winners, bailing out of the right thing at exactly the wrong time. Over 20 years, that 1.11% annual gap compounds into something enormous. Start with $100,000 at 10.35% and you get $717,000. At 9.24%, you get $580,000. That's a $137,000 difference created entirely by behavior, by checking the account, by reacting, by doing things when the correct strategy was to do nothing. Here's why this matters for your $1,000. Individual stocks and actively managed funds do not just cost more in fees, they create more behavioral interference. When you own one stock and it drops 30%, you feel it personally. You watch it, you second-guess yourself. You either sell at exactly the wrong time or hold through a full collapse telling yourself it'll come back. An index fund drops 30%, the entire market is down, and somehow that feels less personal and easier to hold through. The boring choice is not just cheaper, it's psychologically easier to stay in, and staying in is most of the battle. Let's run the real numbers, not hypothetically, specifically.
You invest your $1,000 today. You add $100 a month on top of it. That's $1,200 a year, not an aggressive number. The market returns 7% per year gross, which is conservative based on long-run historical averages. In an actively managed fund at 0.64% in fees, your actual annual return is about 6.36%. After 20 years, roughly $48,500. In a total market index fund at 0.05% in fees, your actual annual return is about 6.95%. After 20 years, roughly $53,500. That's a $5,000 difference on $100 a month. Now, stretch it to 30 years, because if you're making your first investment, you probably have 3 decades ahead of you. Active fund at 6.36%, roughly $106,000. Index fund at 6.95%, roughly $124,000. $18,000 difference gone, not lost in the market, paid to a fund manager who, according to 25 years of SPIVA data, had a 94% historical probability of making you less money than the alternative you didn't buy. I want you to hold that $18,000 number for a second. That's a down payment contribution. That's a year of college tuition at a state school. That's a used car, a home renovation, a year off from worrying about money. And you get it not by being smarter than everyone else. You get it by not paying someone to be worse than the market on your behalf. Here is the reframe I want to leave you with before we get into the actual solution. The decision that feels most intentional, researching a company, identifying a trend, picking a winner, is statistically the worst performing decision over a 20-year horizon. The decision that feels like the absence of a decision, buying a low-cost total market index fund, is statistically the best performing one. This is what I call the intentionality illusion. The feeling of being intentional and the reality of getting good outcomes are pointed in opposite directions for most first-time investors. And here's the thing about index investing that most people have completely backwards. When you buy a total market index fund, you're not opting out of owning great companies. You own all of them. You own Apple. You own NVIDIA. You own every company that might be the next Apple or NVIDIA. You own the companies nobody's heard of yet that will matter in 15 years. You own it all, at once, for almost nothing. The individual stock picker is trying to identify one runner who will win. The index fund investor owns the entire race. If any American company wins over the next 20 years, you benefit. That is not settling. That is understanding the game well enough to stop playing the losing version of it.
If you want to keep seeing the math behind financial decisions that most people make on feeling, subscribe to Cole Capital. No sponsored products, no funds paying for placement, just the numbers. Okay, enough of what not to do. Here is exactly what to do. Specific steps, real fund names, no vagueness. Your first $1,000 investment is actually 2 decisions, and almost everyone focuses on the second one while completely ignoring the first. That is the second biggest mistake in this whole conversation. Decision 1, where you put it, the account type. Before you open a regular taxable brokerage account, ask yourself one question. Can I open a Roth IRA? Here's who qualifies. You need earned income, a job, freelance work, anything where you're paying taxes on what you make. And for 2026, the income limits are under $153,000 a year for single filers and under $242,000 for married couples filing jointly. If you're above those numbers, there's a workaround called a backdoor Roth. That's a whole other video. But for most first-time investors, you qualify. Why does this matter? Because inside a regular brokerage account, your investments get taxed every year. Dividends taxed, capital gains taxed. The government takes a cut of your growth annually before you ever see it, forever. Inside a Roth IRA, because you put in money you already paid taxes on, everything from that point forward is tax-free. The dividends, the gains, the compounding, all of it. You pay tax once on the money going in and never again.
That tax protection is worth thousands of dollars over a long investing horizon. It's a free advantage sitting on the table, and most people walk right past it because they're fixated on which stock to pick. For 2026, the Roth IRA contribution limit is $7,500 per year, $8,500 if you're 50 or older. Your $1,000 fits easily. Open the Roth IRA first. Decision 2. What you buy inside it. Roth IRA is open. $1,000 is sitting there. Now you're back at the search bar. Here's what you type. At Fidelity, FZROX, the Fidelity Zero Total Market Index Fund. Expense ratio, 0.00%. Not a rounding error, literally zero. It owns a slice of over 2,500 U.S. companies and charges you nothing. One note, it's a proprietary Fidelity fund, so if you ever move brokerages, you'd need to sell it and rebuy elsewhere. Inside a Roth IRA, that's not a tax issue. At Vanguard, VTI, the Vanguard Total Stock Market ETF. Expense ratio, 0.03%. One of the most established index funds on Earth. Transferable to any brokerage if you ever move. At Schwab, SCHB, the Schwab U.S. Broad Market ETF. Expense ratio, 0.03%. Identical function to VTI. All three own essentially the entire U.S. stock market. Thousands of companies, automatically diversified, automatically rebalanced. You are not betting on one company. You're betting that American business as a whole continues to grow over the next 20 to 30 years. That bet has paid off in every single 20-year rolling period in U.S. market history. Not most of them, all of them. The 5 actual steps. Step 1. Go to Fidelity, Vanguard, or Schwab. Pick any of them. They're all fine. Open a Roth IRA online. You'll need your Social Security number, your bank account info, and about 15 minutes. Step 2. Fund it with $1,000. Allow 2 to 3 business days for the transfer to settle. Step 3. Search the ticker, FZROX, VTI, or SCHB, depending on your brokerage. Enter your $1,000. Confirm the purchase. Step 4. Set up an automatic monthly contribution. Even $50 a month, even $25. The automation removes the monthly decision. Every month you have to manually decide to invest is a month you might talk yourself out of it. Step 5. Do not touch it. I know that sounds too simple, but compound interest is not a trick. It is time doing its job, uninterrupted. Every time you log in and rearrange things, every time you react to a market headline, every time you second-guess the position, that's not improving the outcome. That's interrupting the process. Remember that 1.11% annual behavioral gap from Dalbar? That gap lives in the login screen. Let me tell you what your first $1,000 actually needs to be. It does not need to be exciting. It does not need to be impressive. It does not need to make a good story at a dinner party. It does not need to prove anything about your research ability or your market instincts or your confidence. It needs to compound. The boring decision, Roth IRA, Total Market Index Fund, automated monthly contribution, leave it alone, is boring because it works. It has worked for every 20-year period in U.S. market history. It costs almost nothing in fees. It protects your money from annual taxes inside a Roth, and it removes the behavioral interference that costs the average investor over 1% per year. And it does all of that while you sleep, while you work, while you're not thinking about it at all. The choice that feels like you didn't try is actually the one that takes the most discipline, because the market will drop 30% at some point, and everything in your brain will scream at you to do something. The investor who does nothing, who looks at that number and just holds, is not being passive. They're executing a strategy that 94% of professionals couldn't improve on. That is the most intentional investment decision you can make. Here is the one thing I want you to go check yourself before you do anything else. Not because you should take my word for all of this, but because you shouldn't. Go to the IRS website and look up Roth IRA contribution limits for 2026. Confirm the $7,500 number. Then go to Fidelity, Vanguard, or Schwab's website and look up the expense ratio on FZROX, VTI, or SCHB. 2 minutes, 2 searches. Then come back and tell me the math doesn't work in your favor. You came into this video with $1,000 and a search bar. You're leaving with a Roth IRA, a ticker symbol, a fee structure, and 30 years of math working in your direction. What exactly is stopping you from doing this today?